Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide online divorce mediation and valuation services in St. Louis, Missouri. Today, we will discuss growing the value of your business. And all of this is from a business owner and value growth consultant perspectives with Garth Tebay. Garth is a practicing certified public accountant, a certified valuation analyst, a master analyst in financial forensics, and certified in mergers and acquisitions analyst with over 46 years of experience. He's the founder and managing partner of Value Defined, a business valuation and litigation support firm in Toledo, Ohio, and an affiliate member of Business Growth Alliance, which provides value growth consulting and investment banking services to owners of medium-sized businesses. One thing that I think is interesting in this process is that it does give the business owner a better concept of what a purchase price would be and what is involved, because another thing that we're seeing is transactions where buyers right now and ever are approaching successful businesses to purchase them. So we're having a reverse thing happen, that somebody just comes out of the blue and they might be a perfect buyer. And so then you need to ramp up. Well, if you're already ramped up, then you're ready to go.
Right. And the longer that due diligence goes on, the more risk you have on the price. Mm-hmm. I've been through so much transactional work. It's the bulk of what I do now. And we really don't want that due diligence to go much more than 90 days. Mm-hmm. If it starts to drift into 3 months, 6 months, 9 months, we're in trouble.
Mm-hmm. Yeah, no. And I think that the other thing is that, just conceptually for business owners, so a buyer comes to you or a competitor, or somebody that you know, and they're like, oh, come on, like, what would you sell it for? Well, what would you sell it for? Now, in the example that we've talked about, if that buyer's like, well, I don't know, maybe I'd sell it for $6 million. And the seller says that, and the buyer's like, $6 million? What the hell? You've already pushed somebody off by just spouting out a number that you kind of thought was rational that had no basis in reality. Right. And you could have pushed off somebody, that's like me saying, oh, I want to go buy this car. And they're like, oh, it's 100,000. I was like, nope, don't want that car. And they're like, oh, I made a mistake. It's 20,000. And you're like, what's wrong with the car? Right. And that's the same, I don't think that companies understand that is the same process that goes through the head of the buyer. And quite frankly, you should never tell them a number, ever.
No.
Ever.
No. I mean, we're in an ideal world. One buyer is as bad as having no buyers, mm-hmm. right? And mm-hmm. so to the extent we can create a competitive environment with multiple buyers, we're going to have the biggest and most success. So maybe that'll happen, maybe it won't, but that's mm-hmm. at least the direction we'd like to go in. And buyers always want to know, well, what's your asking price? Well, we would prefer that we give them the information, they come back with an offer. Mm-hmm. Now that doesn't always work, but it is at least the strategy we'd like to start with.
Well, and I think some of the framework, because we do a lot of the same process, is why don't you give them that 5-year summary of the financials, your income statement and balance sheet, and even sometimes we'll do it in a real condensed format. So we're not giving all the details. We're not giving tax returns. Get them to come forward, and we're running those adjusted numbers through a valuation model, so we know where they should come. And then really, if they come much higher, okay, great. If they come much lower, we have to have a reference point. And so I think that that's another piece of it. And then a lot of it's negotiation, and it's hard to negotiate when you only have, it's hard to play poker with your own money. And that's where you really do need advisors to help you with that process to negotiate that purchase price. But it's not just saying, I like to tell people, well, if you throw out a number, you've basically created the highest number anybody's going to give you. You will never get higher than that number.
Right.
And whereas if you just give them the information, assume that the buyer is smart, right? Assume that they're smart and that they can come up with the best number with those financials. Maybe they'll come higher because that's the strategic value of the company. And the whole purpose is that if somebody has some more knowledge of your field and could take your services or products and put them right into their own company, they could pay more for it than what you've looked at.
Exactly right. I like the story where I was engaged by a potential buyer in an auction. And the way the auction worked is there was a data room, and you were first qualified as a buyer. And once we got through the qualification, then we could make a reservation to go into the data room and spend as much time as we want. And then we would formulate our offer, and then we would send it in as a bid. Right. And I remember sitting down with the buyer, my client, and saying, here's what I think the price is. And I can remember the client saying, well, no, we need to up that price. And I said, well, what, are you crazy? I mean, it's worth $10 million. And they said, well, we won't get it at 10. And I said, well, how do you know you won't get it at 10? He says, I just know I won't get it at 10. We got to go 11 million. And I remember this conversation and the dialogue that was going on, and it was all driven by the process itself. It wasn't, it had nothing to do with the fact of what the numbers were. It had a lot to do with that there was a perception that this was going to get bid up. And the reality, Melissa, they didn't get the bid. It sold for much higher than that. It is a process that is driven by synergies and emotions and who are the buyers. And you can definitely maximize value if you can create that environment.
Yeah. And some people, I think that there's a lot of ways to sell your company. Some people are like, I've identified somebody I think is a good cultural fit. I want to work with them. I want to transition to them, because the reality is at the end of the day, the transaction, everybody thinks it's all about the purchase price. And I try to tell sellers this all the time, like, it's not going to be about the price at some point. It's going to be about your legacy, your people, yourself, and all of that comes into play. But I think that even going through the process, because most of the time when you do that 3 to 5 year look back, you're asking questions like, well, what happened to this bad debt in 2018? And they're like, I don't know. And they have to go ask the questions. So all we're doing is asking the questions before a buyer is going to ask them as well. And then the answer. Now if somebody asks that question, they say, oh yeah, so that particular client didn't pay us, blah, blah, blah. And you have it immediately. That is it seems like a more intelligent seller. It seems like a more knowledgeable seller. They know their finances in and out. That's more likely to get a higher price as well, because they think that it is a very efficient, effective system.